Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. We haven't had John Manfreda on in a while of Wall Street for Main Street, so we're going to have him, and I'm going to ask him some questions, and we're going to have a nice interview/discussion here. So thank you for coming on for a podcast, John.
Thanks for having us. So.
Yeah, man, we haven't had you on in so long. You're a good analyst and a very hard worker, and you have very good insights into the markets, and our listeners need to be more familiar with you. That you come out with a lot of good answers.
Yeah, I've just been burnt out from my job, so that's pretty much what's been doing it. So.
Yeah, exactly, man. I mean, I'm burned out too, like just cranking out these podcasts and stuff like that. But I mean, it's gonna be rewarding because look how much we're rising up on iTunes, and how fast we're moving up on views on YouTube and things like that. We've gotten a lot more views than I thought we'd ever get, and things are rapidly increasing on iTunes thanks to our listeners here who are giving us really good reviews.
Yeah.
Well, John, you made a comment before we started recording, and I think it's an important one. I definitely agree with it. You said the markets are boring now. Can you elaborate on that further?
Sure. I think they're boring just for a couple of reasons. One, I think the manipulation and the doctored up numbers have gotten so obvious and so induced from the media, from the government, that nothing's really changed. And what's unreal is how all these job numbers, every time now, it's since December. December they had a bad jobs number, but since then it's been roughly 175,000 plus jobs created, or 200,000 plus jobs created. And the thing is, the story hasn't changed. They're all part-time jobs. None of them are high-paying jobs. And yet the media just beats and beats on this recovery story.
Hopium.
Yeah, the reality is incomes are falling, and you see the BS employment numbers because you don't even have to look that far. Look at GDP numbers, look at factory orders, that has slowed down. You look at service sector. If you look at a lot of that, that doesn't support a strong employment numbers. And not only that, it's so obvious. Anytime there's a big sell-off, like I remember the other day, the Dow dropped 150 and only closed down 30 points in the red, or drop 50, and then all of a sudden it closes up 4 to 5 points. They won't allow any type of correction. It's so obvious that any down day, the plunge protection team, the Fed, whoever, is coming in and buying and just won't let anything happen to the stock market.
Yeah, it's either the Exchange Stabilization Fund or the Plunge Protection Team, or it's hedge funds betting that QE is going to reverse at some point. So it's really amazing how doctored all of these markets are, and it's not just precious metals. There are so many markets. I mean, the bond market, the interest rates are suppressed. The currency markets, the fines there. LIBOR has been rigged. There's just so much evidence of market manipulation. And if you talk with Eric Hunsater, who's a high-frequency trading guy, he has detailed many examples of market manipulation in the general stock market, in individual stocks, naked shorting and other types of things that happen. And there's just so many examples of market manipulation, what you said, but it all goes back to, just all these central banks flooding the markets with fiat money. And the people who are printing all this money, they're not going to hold on to the money because they know that, everyone else is printing money and that the economy is not really recovering. If the economy was recovering, John, and you named some statistics already, we would have full-time jobs created, right? We would have higher CapEx numbers. We're not having enormous CapEx numbers. And another key statistic, and this is probably the most important one, is velocity of money would be higher, right? Wouldn't there be a lot more turnover in the economy in terms of the banks would be lending out money to small businesses instead of the banks, either holding the money at the Fed or speculating on it in asset prices and things like that. And the velocity of money has fallen off a cliff.
Well, yeah. And not only that, look at Walmart. They're complaining about lack of sales, how middle-class consumers have no discretionary income. Walmart would be booming if we had a true economic recovery. GM, a lot of these middle-class stores are struggling. And
GM's giving away their cars, though, right?
Yeah,
with subprime.
They are a poor company, so they are a poor example. But it's not just that, but the other thing to show just how rigged these markets are, they come out with great numbers or great job numbers. No matter what, interest rates won't rise. The 10-year just stays the same no matter what. If we had such a great economy and they were going to really end QE and then renormalize monetary policy, you would see interest rates going up, yet they're falling.
Exactly, John. And what also surprises me, too, is besides just the U.S., interest rates are even cheaper in Europe, and there's more risk in Europe, right? And then look at Japan, where there's some days where Japanese government bonds don't even trade, or a couple hour periods. I think there was at least one full day where Japanese government bonds didn't trade because the Japanese central bank had bought them all. And, I mean, these guys are all manipulating interest rates. They're using monetary policy to try and gain an advantage in trade. So, yes, maybe if they're China or stuff, they're running dollar pegs, right, and they're creating inflation that way. And they're voluntarily importing some inflation from the U.S. when the U.S. does QE. But their monetary policy is intentionally being done to devalue their currency to try to gain an export in trade, because everyone's using Keynesian economics, which is based off of, even earlier examples of mercantilism.
Yeah, I definitely concur with that. You see it all the time, anytime. It was like back in 2012, the ECB announced monetary stimulus. A week later, Ben Bernanke came out with his $40 billion in mortgage-backed securities. And then in December with this $45 billion in treasuries. And you see it all the time. China's talking about more QE because they're having economic slowdowns, and of course they'll need it to export. So everyone's doing it. You see it all over the world.
Yeah, and I think China's going to have to do some bailouts, too, because they have municipalities that have problems, and their banks, which the Chinese government has forced to give out, bad loans, they're going to have to cover those loans. And it's like that in a lot of cases. I mean, in Europe, you have the European Central Bank and the Bank of International Settlements and the IMF and other people, economists, or Keynesians, writing about bail-ins. So they're talking about wealth taxes. They're talking about bail-ins. I mean, it's a possibility. They've already gone to negative interest rates in Europe. And, I mean, if you're going to have negative interest rates, why should interest rates be lower in Europe than they are in the U.S.? It just doesn't – almost none of the stuff, John, that we're seeing right now in the markets makes really any sense to me, except that gold, silver, and oil really for the last, 8 months have done really well on a relative basis, because I think they should be, because those are some of the safest things right now because of all this money printing globally. I mean, precious metals should do well, platinum and palladium should do pretty well, and oil and natural gas and food and those things seem to be good, especially, with all this food price inflation that we're seeing globally.
Yeah, actually, the one thing that actually makes sense in the marketplace is palladium. There is a shortage in that market, and it's going up. It's actually nearing its – I don't know if it's surpassed it, or I don't know the exact statistics, but it's near its 2011 high. And palladium's doing well, and that's probably the only real sane thing happening in the market. Yeah, you're definitely right. The precious metals, though, that's actually this year has outperformed the Dow. And that's very few people know about that.
Yeah, and I think people are finally starting to realize this, watching the indices for the gold stocks and stuff like that. The gold stocks are finally starting to outperform the metal, which is normally in the past, John, since you and me have been in commodities for a number of years now. That's a good sign going forward that the long-term bull market is back when the mining stocks start to significantly outperform the metal.
Yeah, I'm actually really excited about the mining stocks. I still think they're cheap. I'm hoping to add more, but I have some medical things I have to pay off first. But not only am I hoping to add more, not only are they cheap, but since this correction, a lot of miners are cutting the fat. A lot of them are divesting. They're increasing profit margins, and they look leaner and meaner, and they look like they can really do well the next run up.
Yeah, I think that's a very valid point that, when silver went down to $18 or lower and gold went to $1,200 and it went a little bit lower and then it went kind of sideways for a while, the miners had to go into full panic mode because a lot of these guys had so much debt on their balance sheets. They had to cut all the fat, like you said. They had to cut every single expense just to survive. So they were almost to the point, John, where if prices hadn't started to go up again, where they were going to start shutting off a large portion of their mines. And given reality, reality is the supply-demand fundamentals for the actual physical commodity, we knew that those prices, gold at 1,200, silver at 18 or lower, gold at 1,200 or lower, those things were not sustainable at all. It's not a sustainable environment given the supply and demand that we're seeing. So, maybe they could have knocked down the paper price a little bit lower, but it would have shot right back up because the miners would have, just turned off the taps, and there would have been so many people out there with cash who wanted to go in and buy physical metal.
Oh, yeah, that's definitely true. And I personally think if it went any lower, I can't prove this per se, but I think China would have just started buying the miners outright, just so they can own the mine, they can do whatever they want. And in China, they're actually subsidizing mines where their costs are $2,500 to extract it. And well, why is China subsidizing that? Well, it's obvious. They know gold is going to be much higher in the future.
That's a good point, John. And if the thing about China is at least that part of their economy is closed, so they don't really care if they're going to pick up that physical gold at a loss. They're not going to let it leave the country really, and they know that the U.S. government is devaluing their treasury holdings with the QE programs, right? And that's something else you brought up, before we started recording here. Is the Yellen, all these other guys at the Fed, they're talking about taper. That they've announced in public taper, but what are we seeing in the Treasury data? It indicates that there's not really a taper at all, is there?
Well, no. Even the money supply has been increasing. Now, I haven't looked at the latest statistics, so I haven't say. But since the taper, the money supply hasn't even increased.
Yeah, it's a good point. And also look at the
decreased. It hasn't decreased. Sorry.
Yeah, that's a good point. The base money supply really since the 2008 has gone vertical. It's gone absolutely vertical. I think we're over $4 trillion in base money. Now that money is not being lent and spent throughout the whole economy here in the U.S. because the velocity money is proving it's not. But that doesn't mean that those reserves at the Fed are going to fully sit idle. Those reserves can be used for collateral for the yen carry trade. They can be used for collateral for real estate purchases all over the U.S., foreign real estate purchases, derivatives markets bets. They can be bond purchases, foreign bond purchases. They can be used for a ton of other leveraged deals or speculative bets. So the money can stay there at the Fed, but it can go out into the asset market and have, create tons of asset bubbles. And it's not just the U.S. that's doing it. With this yen carry trade going on, that's created a humongous amount of asset bubbles since the yen carry trade has gone on too.
Yeah. Well, definitely. The yen, Japan's just finished.
Yeah. What I'm in shock at, John, too, is that the yen hasn't collapsed yet. It's actually strengthened a little bit. This is very perplexing here because you listen to experts like Kyle Bass and others, and they've talked with the people at the Japanese Central Bank, and they want the yen down to like 115 to 120 by the end of this year just to make their numbers work, right? Just to pay off their debt and help that. But Japan's just flooding themselves with inflation for their energy imports and their food imports. And, we're seeing that here in the U.S. too. Despite the shale boom, right? We've had enormous the U.S. has had the largest oil production increase in the whole world by far. And yet gasoline prices here in the U.S. are still, at least here in Virginia, they're still around $4.
Yeah. Well, the thing is, this shale oil, a lot of it can't be produced below $90. That's why there was one correction in the late 2013. It went to 92. It didn't go below that. And it can't go really much below that. In the 80s, 88, it was at 88. And it was only there for like a day. So a lot of this, and the other thing is with gasoline, you can export that. So it's a worldwide market that you got to think of. So WTI and gasoline, there's a little bit of a difference. That's why when I think they talk about these new oil exports, I don't think it's going to affect U.S. consumers at the pump so much. What I think will affect them is the utility bills. Because right now they have cheap natural gas, but that's because it's only traded in North America. But once that's exported, the real sting for the American consumer will be their electricity bills. their gas, I don't think will change much, if any, because oil and gasoline can be exported, but the natural gas utility, that's still more localized, I think.
Yeah, that's a good point. And in addition to that, I mean, my electricity and utility bills are all up. My healthcare bills with Obamacare and other nonsense are also up. They're going up, high single-digit, double-digit rates per year. My food bills are going up insanely high. To give our listeners some examples of how high my food bill is going up, I eat at this taco place called Cafe Rio. It's a chain. They have good tacos. There, John, you've eaten there with me before. And I get like the same taco meal every Taco Tuesday. And 2 or 3 years ago, it was like $8.50 for the 4 tacos and a drink that I get for lunch. And now that same meal is like $13, only a couple of years later. And then there's other examples where today, like, I just opened up an Uncle Ben's rice package, and even a few months ago, there was twice as much rice in there as there is now. The package is mostly air, and there's barely, like, in the past there was enough rice, for like 3 people or something, and now there's barely enough rice for 1 person. And, we're seeing that with a lot of food prices. Like, the price of steak is up a lot. The price of steak, I think, in the last 2 or 3 years has more than doubled. The price of pork has gone up due to some shortages and droughts and other things.
Oh, yeah, you can definitely see it. And the funny thing is, I was actually at the movies the other night. I watched that documentary that came out in America. I went there one day after work just to see it, and I haven't bought movie theater stuff in a long time, but I actually bought a little bag of M&Ms, and gosh, were they smaller than when I bought them a year ago. It's like they serve the sizes at a gas station now. It's unreal how much that has downsized, and it's still a ripoff. So.
Yeah, and it's just clever ways that they're doing for the inflation here. So they're doing shrinkflation, or they're keeping the price the same, and then they're reducing the portion size by 50%. Like I ate at Romano's Macaroni Grill, which is a well-known chain by Brinker, which is symbol EAT on the New York Stock Exchange. And at Romano's, like, they used to have really good lasagna, and it used to fill up a humongous tin of it. It used to be a huge brick of lasagna, a lot of meat and cheese, and it used to be piled very high a couple years ago. And the price of the lasagna stayed the same, but they serve the lasagna in the same dish now, and the lasagna portion now takes up half the dish, whereas it used to fill the whole dish, and it used to be higher than the dish. And, there's hardly any meat and cheese in there anymore. So they're figuring out clever ways to hide the inflation and margin compression and things like that, man. And, they're still doing with the CPI, like even the CPI numbers, John, I think showed increase in inflation since 2014 started, but they'll probably start changing the formula again with chain CPI and other stuff. I know that the MIT Million Price Index, or Billion Price Project, I think, is it the Million Price or Billion Price for MIT? I forget which one.
I think it's Billion.
Okay, Billion Price Project, that says the real inflation rate's at 4%, but they don't count cost per ounce. So they don't look that your $4 box of cereal, it's decreased from 30 ounces 3 years ago down to 20 ounces now. They don't calculate that. So they would just see that the price went up from $4 to $5 or something like that. And they wouldn't see that the cost per ounce, it increased massively there, and you're getting way less amount of purchasing power of goods for your money.
Yeah. Well, the thing is, even the CPI is 2% year over year, and I've been watching the CPI and the unemployment numbers really closely, and the only reason I would say is I think those are the easiest to doctor up, and I personally think this recovery story is going to die when the government's unable, or not unable, but is starting to have real trouble doctoring up those numbers. And so those are the two numbers I've been watching the most. And even the CPI, it looks like they're having trouble doctoring that one up.
Yeah, and the employment numbers, like you said, are very important too. GDP with a real inflation rate, with even a 4 or 5% inflation rate, which is a lot more realistic, there is no growth then. In Q1 2014, the U.S. economy then massively contracted. If you put a 4 or 5% inflation rate, and that's probably low given the food price environment that we've had. So we have enormous amount of asset price inflation in the economy because the real estate market's back and booming here in the DC. John, I don't know about you, but I'm seeing friends on my Facebook Facebook friends list. I'm seeing people quitting other jobs and starting to become real estate agents. So that's a big red flag to me in terms of real estate bubble here in the DC metro area.
All I see is for lease signs everywhere I drive. So that's the only
construction cranes too.
Well, of course the government programs are slowing down traffic and everything. I'll be honest though, I'm actually benefiting from that because it takes longer to get to work, and right now they just don't care if I'm 10 minutes late. So, so I've actually benefited, and I'm always going on the opposite side when I go home. So that hasn't affected me much. Actually, it's benefited me. So I guess that's the only good thing about these programs. So.
Okay, well, since we haven't had you on in a while, let's talk about some of our predictions for 2014, and have things played out how you expected them to in 2014 so far, or have things not played out quite a bit differently in certain things?
Well, I'd say our idea of precious metals having a good but not great year, I think that's sort of playing out. I think it can go up much longer. Like they talk about ending QE. I personally think they might be, quote-unquote, telling the truth. And when I mean telling the truth means they just will end this type of monetary policy tools, and they might just use another one, and that will be the real catalyst. Because I think once the West gets back in, gold will go parabolic, because now it's no longer just China and India buying. And not only that, they have the India is greatly reducing their import tariffs soon. So that will increase demand. So I think that will happen. I'd say energy, and I'd say most of this is just more of the same. The stock market's treading above water. It's up a little, but it's not doing great. So.
Yeah, a lot of those large cap dividend stocks, they don't look like bargains to me. If they bombed earnings like Hershey's Chocolates did, and then Porter Stansberry got his subscribers into that, for really quality, consumer staple company bombed earnings, that would be an interest for me as a long-term buy and hold and a yield play. But we're seeing so much money out there. Like, people are desperate for yield, John. People are chasing and paying pretty high valuations for a lot of stocks and MLPs and consumer staple dividend stocks and MLPs and things like that, because even for junk bonds and stuff like that. So people are drastically overpaying for any type of yield right now. The best values to me in the market are, select small caps, some select turnaround plays here or there if a really quality company bombed earnings and didn't meet expectations, and then, of course, commodities. So, I don't like base metals that much, obviously. I really don't like them.
Except for zinc. Don't you like zinc?
Oh, yeah, I think zinc is fine. I think zinc is fine because there's a legit supply shortage there, and it's also a byproduct, so it could get shut down. But, I don't like copper, iron ore, steel. Coal, I think the environmentalists and the energy market's not a free market. I think so many governments are really trying to phase out coal. So I don't think there's going to be humongous demand increases for coal. The amount of regulations and extra rules and restrictions and taxes on coal companies, it's going to really make it difficult, especially here in the U.S., for a coal company to stay in business, let alone be profitable. But, I really like the food plays, companies that produce proteins or, can grow organic foods that sell at a premium. If there's any of those publicly traded companies, I like gold, silver, platinum, and palladium, and I like oil and natural gas. I like oil and natural gas a lot, John, because it can't be recycled. I think that's probably the best part. Is once it's consumed, it's basically gone. Although in the lab, people can technically create oil, you can create synthetic biodiesel, but it's just not economic right now.
Well, the thing is, the energy trusts are doing actually really well. The Canadian ones, I always thought. I really like them, and not only that, they actually have shale oil exposure. But the thing is, they're sort of like the miners. They cut their fat. They increased. Like one company divested a lot of heavy capex stuff, and is for some reason, I don't know why, but Canada's getting a lot of this light oil now, which is news to me. But they're getting that, and that's something very overlooked in the markets right now. And not only that, the Enbridge pipeline, that's approved now. It has the government's blessing, so Canada might not even need the Keystone pipeline anymore.
Just for our listeners who are not familiar, the Enbridge pipeline, is that one that's going from Calgary area to the Vancouver area, so the oil can be sent to Asia or China?
Yeah. Sorry. Yeah, I should have done that. So.
Yeah, I think those are good investments right there because those are really out of favor. Like a lot of the oil sands plays are out of favor. The Canadian light oil plays are out of favor because the market just says that, the Keystone Pipeline's not going to get put in and this oil is not going to get to a port or the right refinery to get a better price. And the Canadian oil is at such a huge discount, right, to WTI. I don't think that type of discount is permanently sustainable.
Oh, no, not at all. And not that China knows it, and that's why China is working with Canada so well. So I always like that, and I like uranium. I think that will take longer. I think a lot of the Chinese power plants come online in 2016. So unless there's a Fukushima or something again, I think that's still a good one. But you got to be careful. I think a lot of people are better off just buying Cameco.
Yeah, that's a good call. I think uranium, definitely people should have at least a portion of it in their portfolio, but people have to have very measured expectations because at any time we could have another Fukushima because some of these nuclear power plants were so poorly designed that they could potentially break down. I know the U.S. politicians are trying to shut down a lot of them. I think they're trying to shut down the Indian Head one in New York and one or two in California, some of the main ones. I forget the names. But
they're actually growing others, though.
Oh, okay.
So they actually have two coming online, so it will probably be a wash, but...
Yeah, but the key there, the real key swing there is China and Japan, because Japan, so much of their power was relying on nuclear, right? And then they shut it off completely. It'll be really interesting to see what happens in Japan. Japan has a lot of monetary problems, and they have problems with energy and other things. Japan will probably be the first country out of the developed world to really potentially collapse, I think. But we'll see, though, because everyone's bailing each other out. We have, all these currency swaps in the market now that we don't even know about. I had a money manager friend, John, a local guy. You haven't met him yet. Introduce you in the future to him. But he lives around here, and he went to an IMF conference here in D.C., and he was taking notes, and, all these Keynesian central bankers were there, and bureaucrats from all these different countries, and they're talking nonstop about transitioning away from the dollar as world reserve currency, transitioning to the SDR basket of currencies, and also doing unlimited amounts of currency swaps between countries as backdoor bailouts to prevent countries from collapsing and triggering, domino effect with governments and banks and things like that all collapsing.
Yeah. Well, the thing is, markets can act irrational longer than people think. That's why, I personally think there'll be a dollar collapse, but I think it might take longer than people expect. And there are people that say I'm crazy, but I think this could go on. This game might go on for... Now, when I mean game, I don't mean manipulation of precious metals. I don't think that can go on, but, just propping up the system, I think, will go on. I think precious metals, we've seen the worst. I don't think it can get any worse.
Yeah, I think we've definitely put in a bottom now. I don't know if we're going to go. I don't think we're going to go straight up because there's a lot of overhead resistance on the charts. But we put in a solid base, and the secular bull market after the cyclical bear market, the secular bull market I think has started again.
Yeah.
And I really like oil and natural gas investments throughout the value chain there. And then we talked about uranium, potash is interesting to me too with higher food prices. Farmers are going to want a higher crop yield. Eventually at some point. So potash has been down and out for a couple of years. It's been in a cyclical bear market too. So potash should do pretty good going forward. And, other than that, I think one thing our listeners need to realize is that, the politicians can change the rules anytime they want. And, we've seen that with tax laws on mining companies in Mexico and elsewhere. And we've seen that with, politicians in France with precious metals and different governments trying to outlaw Bitcoin and things like this. So as long as you have, a decent amount of diversification and you're paying attention to the stupid rules changes of these politicians and seeing what stupid games the Keynesian central bankers will play to keep kick the can down the road and keep the system going, I think you're going to end up okay.
Yeah, that's the thing. The government's always changed the rules, so that is something you always got to be prepared for and have some diversification. I would say the most important is geographically.
Yeah, I would definitely agree with that. And in terms of also diversifying within commodities, like we said, And also, if there's the right small cap company, because if there really is a good biotech company that comes out with, a specific cure for a specific type of cancer, because I read a book recently about cancer, and not all cancer is the same. Different cancer acts differently. So there are certain cancer drugs that are able to target other ones. Although, if you look on the internet, there are certain documentaries that claim that certain things like hemp oil and other neoplastones and other things can kill and also the Gerson therapy can kill cancer, all types of cancer. I guess with eating healthier and exercising and other preventative cures like that, instead of after treating symptoms and things like that, I think it's good. But yeah, I'm really excited for going forward here, and I'm really grateful for our listeners. Wall Street from Main Street almost has 300,000 views on our YouTube page. We've gotten a lot of good reviews on our iTunes page. Getting a lot of downloads there, and we're starting to get some paid consulting work. So it's all starting to come together. We have some good guests booked, John, for the next couple weeks, and we're working on some other big name guests. I don't want to name them until they're booked. But, things are looking up. Some really big-name guests that we haven't had on yet.
Yeah.
Well, John, let's just wrap things up here. You wanted to keep things around 30 minutes. Thank you again for your time, and, we should do this maybe once a month or something like that, and, I hopefully look forward to you interviewing other guests once in a while and getting back into things. Take a couple week, I don't know, I know you're working your job, but try to take a week off, man, and just relax.
Yeah, definitely. So it's good to be back on again, and hopefully these markets won't be as boring. So it's, but I do think the doctored up numbers, it's unreal that in 2013, like all the numbers were great, and now you're seeing cracks in GDP and sector growth. So
time to change the formulas, John.
Yeah.
They've already changed the CPI more than 20 times since 1980. They're going to just start changing the formulas again, probably.
Yeah.
Okay, well, thanks again for listening to our listeners. And, if you're interested in consulting, email us, wallstreetformainstreet@gmail.com. We do a good job teaching you how to use fundamental analysis, become a value investor, and other types of investing methodologies and techniques. And you can follow us on Twitter or on YouTube or download us on iTunes. Thanks again for your time.
One other thing. If you enjoyed this podcast, write a review on iTunes and just tell how much you liked it.
Exactly. That would really help us out, because we think we provide some of the best interviews and quality content on the internet. There's other people that have higher rankings than us, but in a year or two, I don't think that's going to be the case. I think we're going to be on top. Okay, bye now.